Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. So President Trump has extended a tariff truce with China for another 90 days. This was set to expire on Tuesday. Sources tell Bloomberg the president signed the order for the extension on Monday. And this truce, just so you remember, eases duties and export restrictions on key goods like rare earth magnets. And we got reaction from Henrietta Treyz. She is Director of Economic Policy at Veda Partners.
Now that all eyes are on inflation data coming out tomorrow, this is not an opportunity that the president can afford to have tariff rates spike on, $550 billion worth of goods coming in from China. So this had to occur, in my opinion. The president didn't have another play. He had to delay.
Henrietta Treyz there of Veda Partners. Now, the extension could also clear the way for further cooperation on chip exports and AI hardware sales, although, to be fair, national security issues do remain. Coming up, a look at the market implications with Joy Yang. She is head of product management at Market Vector Indexes. But we begin in San Francisco, and that's where we find Derek Wallbank. He is senior U.S. EcoGov editor for Bloomberg News. Derek, thank you for making time to chat with me. Remind me what the situation on tariffs would look like had the president not agreed to extend this pause.
Well, thank you for having me. Look, the situation would look bad. That's where you start. When we first got into this U.S.-China sort of tit-for-tat, it escalated quickly, and it escalated past, I think, where either side had planned on it going, to a point that markets got spooked, and so that sort of was the preceding moment for a kind of climb down and truce and pullback. And so that's kind of what we were looking at. There were all of these sort of worst case scenarios going into place in terms of tariffs, but also potentially non-tariff issues. And all of those have come off the table now for another 90 days. This extends a truce through November 10th, which is a really important extension here. Not all extensions are created equal. And one of the things that we've been trying to track is the prospects of a potential meeting between Trump and Xi Jinping. Now, nothing has been announced. Nothing has been said that they're close to, whatever. But the current noise in Washington is that you can sort of circle a period of time kind of around the APEC summit in South Korea, which is going to be around Halloween time, early November. And right around there's been some noise. Maybe on the sidelines of APEC, maybe Trump could go to China, somewhere in late October, something like that. And so an extension through November 10th gets you through that potential window when I think a lot of people in Washington have been saying that if Trump and Xi were going to meet this year, it might make sense for them to meet.
I'm wondering about the timing in the context of Trump preparing to meet with Putin in Alaska on Friday, and whether or not this could be viewed as Trump kind of putting himself in a weaker position. Is there a sense that maybe he caved in a little bit, and could that weaken his hand slightly when he meets with Putin?
In terms of a China to Russia, probably not. I'm not getting a read from people that those two things might be linked. But in terms of a Russia talks thing specifically, I do think that you see a lot from the Ukrainian side, a lot from the European side, very concerned about what Donald Trump might say in a meeting with Vladimir Putin. Trump has been a lot more willing to hear Putin out than a lot of Europeans and a lot of Ukrainian leadership. And there is some concern that Donald Trump may agree to things or say, hey, this makes a lot of sense, to things that Putin wants to do that would be far, far-reaching demands in practice. Certainly the news about what Putin wanted as an offer for Ukraine essentially represents Ukraine giving up territory in exchange for a ceasefire, with Russia not really giving up anything at all at the start. And I think there was a lot of reaction out of Europe that said something like that would represent a little bit of a capitulation. Now, Donald Trump does not want to be seen as someone who capitulates to Vladimir Putin. And indeed, we've seen in recent weeks, Trump has been increasingly exasperated with Putin for not stopping, for continuing to shell Kyiv. But at the same point, this is a guy who for months and months and months has said that Ukraine probably needs to sacrifice far more than it had wanted to in order to get a peace deal, and someone who has said that he very much prioritizes getting fighting to stop. How that fighting may stop, he may be a little bit more malleable on the details than Kyiv and Europeans may wish.
So has this exercise at the end of the day, whether we're talking about U.S.-China or U.S.-Russia, kind of illustrated to President Trump that may not have the degree of leverage that he thinks he has in some of these cases?
Well, I think that there's a really interesting thing with the overall Trump administration, right? Donald Trump literally wrote a book called The Art of the Deal. He sees himself as the world's consummate deal maker, and in so doing wants to go get a Nobel Peace Prize, right? He's said that a lot, but this is somebody who really embraces large headlines. His administration may be not the one that sweats the small stuff, right? The Trump administration. I was in Washington last week meeting with Trump officials, and one of the things that we talked about was the concept of moving at Trump speed. Moving at Trump speed does not always leave you time to check all of the cross T's and dotted I's. And you've seen some examples over the last several months where something has happened. They've said, oh, didn't quite mean that. Let's go back and try and reverse that. So this is an administration that very much wants the big headlines. But when details can get difficult, that can be a little bit more of a trouble zone. Now, when you're talking about, Vladimir Putin, you're talking about somebody who has swum in the details, and China is, if anything, an incredibly technocratic, bureaucratic society that loves details, and so there is a little bit of a mismatch there, where sometimes on the detail side, they may see that they can, try and get one on Trump, but Trump also moves with a rapidity and has a willingness to move so fast that maybe sometimes that sets his opponents on edge. So it's a little bit of each side vexes each other sometimes.
Before I let you go, Derek, I have to ask about the deal that the Trump administration worked out with both Nvidia and Advanced Micro Devices. These companies will be allowed to sell their less advanced chips to the Chinese market if they were to pay 15% of the revenue from those Chinese sales to the U.S. government. Give me your sense of what's at work here.
Well, there's a couple of things that are interesting there. One is that it's generally considered that U.S. companies are not meant to pay duties to the U.S. government for the privilege of exporting. That's a sort of long-held legal concept. I was really struck with something that our Cameron Kreis wrote for MLive, our markets blog, and he basically saying, look, the latest U.S. government intervention has been met with barely a shrug in markets. I was actually interested in that because, these sorts of policies are ones that years gone by, even months gone by, would have been greeted with a great hue and cry from Wall Street and Silicon Valley and all others. Now it sort of barely registers on a Monday. And I think that that's a really interesting sort of development there. There have been a lot of things I think that the Trump administration likes to do in that concept of moving fast and, making demands and doing things and having deals and, all those sorts of things. And they all kind of move together, in train together. And in that movement together, there is so much volume that some things become normalized, and it's hard for your opponents to pick out one or two things because everything else sort of slides by. This is actually by design. This is one of the tenets of the idea of why you move in that sort of in that sort of way, because then things kind of do go by. But because all of this volatility has kept on going, the volatility itself becomes a little bit normalized. And that, I think, is really a sort of fascinating concept there. On the exports themselves, one thing I think is important to watch is that a lot of Trump's biggest China hawk advisors have really sought for him to crack down heavily. At the same time, Trump wants an overall deal with China, and we've seen in the issue of leverage on Russia's oil exports, Trump has been very willing to threaten India with increased tariffs. China is another big buyer of Russian oil. While we have these Chinese talks going on so far, you are not hearing a lot out of President Trump talking about wanting to sort of lay the smack down on China as well. I think that's an interesting note as we consider these next 90 days.
Derek, we'll leave it there. Great stuff. Thank you so very much. Derek Wallbank is Senior U.S. EcoGov Editor for Bloomberg News, joining from San Francisco here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. So markets barely budged today after President Trump extended a pause of tariffs on Chinese goods for another 90 days. Meantime, with earnings season nearly over, the market is turning its attention to economic data for clues on whether the Fed will be able to cut interest rates in September. To help break things down, I'm joined now by Jo Young. She is head of product management at Market Vector Indexes. Joy, thanks for making time to chat with us. Today, it felt like the market was a little bit on pins and needles as we walk up to that CPI report. But to be fair, we're not far from record highs. In fact, the NASDAQ comp dropped today from a record high. Are you still constructive on U.S. equities?
Yeah, so I mean, this is interesting times, isn't it? So we just saw the announcement of another extension and markets are just kind of barely flat, right? Because this is really showing how complicated and messy this tariff policy is. And I think, the handshake is just the easy part. The implementation is really the difficult part and the areas that we're seeing cracks. And so that's why you have a lot of investors just waiting on the sidelines to see what else is going to be exposed, like we saw with the gold confusion, and then unwinding and getting clarity around what actually happens when you sign the deal and, the legal contracts come on board. But clearly, if you look within the markets, AI is definitely still going up because it's a real story and people want to invest in something, and the markets have responded on the back of last week's earnings that there is real growth and demand in the space and that they're willing to look beyond some of the short-term uncertainties around tariff and tariff impact.
Okay, so that's fair, but I want to point out, I was looking today at the latest survey from Bank of America. A record share of fund managers see the U.S. equity market as being too expensive after that sharp rally since April. And if you look at the multiple right now for the NASDAQ composite, 35 times earnings. That sounds or feels to me like it's an expensive market. You don't feel that way?
It's definitely expensive relative to, where we have seen PEs historically. But I think we're also trying to understand, how AI story will play out. And we know that there's strong demand and that innovation is starting to appear across different segments in industry. So, it just depends on how far out you want to look, but also what else are you going to invest in? Because right now we're seeing this divergence between AI tech companies and consumer discretionary companies that are being more impacted by tariffs and exposed by some of the complexities of the tariff fallouts. But even within, and I would say caution investors when they look at the AI stories, not to be so focused on any single company, because we see that even within the AI tech, there's a divergence between some of these large mega players and some of these smaller players that can't get away from some of the uncertainties around how the tariff stories will play out. And they're exposed on both the import and export side of the cost impact. And so, there's still, there's still quite a lot of strength in these mega cap players because they have a lot of capex. They can wait it out. They can also absorb some of the price impact. This is still, it's got legs to play out and, some, time to see what's really going to happen within this sector.
So for a while now, many investors have been playing energy as kind of tangential to the direct AI trade, whether you're looking at a company like Microsoft or whether you're looking at a company like Nvidia. Is the energy complex still something that you're looking at these days?
Absolutely, because we know that, AI is going to require a lot of data, and that data consumption is going to require a lot of energy, and not just any energy, but reliable energy. So there's strong demand for the energy infrastructure and a lot of investment back into that infrastructure because this data consumption is enormous.
One of the things that's been a part of the market's relative strength here has been the notion that we're going to get multiple Fed rate cuts this year. And over the weekend, Governor Michelle Bowman was saying she favors 3. Do you think that's overly optimistic? Will the economy be in such a state where 3 rate cuts are required?
I think it's unclear at the moment because the data really is telling a different story from, what the market is trying to price in. And we know that the market doesn't really reflect the economy. And we also understand now that the tariff impact will take, a while to play out, and it's impacting some of the small cap players more than the mega cap. And this small cap players is, some of the biggest support for driving labor numbers. So, I think that's very optimistic. And, what we're seeing now is strong demand still for alternative assets like gold and Bitcoin that are, really a little bit immune to some of this volatility and noise around inflation, disinflation, and interest rates.
I want to get your take on a story that we've been talking about. President Trump basically allowing companies like Nvidia and Advanced Micro Devices to sell certain chips to China if those companies were to pay 15% of the revenue from the sales to Chinese firms back to the U.S. government. It's a pretty creative approach, isn't it? What do you think of that?
Well, certainly we're seeing this shift from these broad-based tariff policies to increasingly what's becoming a pay-to-play model. And this is, Trump's tactic. He really likes these one-on-one negotiations and exemptions. It's benefiting the U.S. government in the short run, but it does raise real concerns around what are we trading off for this type of, negotiation tactic? Where does this leave national security? Where does it leave market competition? And where does it leave some of these smaller players?
So we've talked a lot about big cap tech, high technology as it's tied into the AI trade. Is there anything else, and we also mentioned power, by the way, but I'm wondering if there's anything else you're looking at these days that you believe represents value in a compelling way?
Well, aside from making sure that investors are diversified across gold and Bitcoin, we think, investors should be diversified against any single stock exposure. So we're still looking at groups or baskets within the semiconductor because, you should have a global exposure across semiconductor. We're looking at, as you mentioned before, the AI infrastructure, and then we're looking at defense tech. And we saw last week, Palantir's stock price on the back of their earnings announcement. And, defense, national security, given kind of the geopolitical risks that are still out there, is definitely a growth and an investment space for investors.
Joy, before I let you go, are there opportunities offshore that you have identified, something you want to share?
Definitely. When, we think diversification means that investors should also look beyond U.S. equities and bonds because, this American exceptionalism, it can be a little bit too inward looking, and we're seeing relative value still in international markets and emerging markets as they navigate the tariff policies. They will ultimately recapture some of the fundamental growth that, they've been storing up for.
Can you give me specific jurisdictions that you like right now? Is it Taiwan? Is it Japan? Is it South Korea?
Well, we always like these emerging markets that have strong trade ties, whether it's Vietnam, Korea, Brazil, because they were lagging, and we see year to date that they're regaining some of the strength that they lost previously.
Mm-hmm. We'll leave it there. Joy, it's always a pleasure. Thank you so much for making time to chat with me. Joy Young there. She is head of product management at Market Vector Indexes, joining us here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.